Ladies and gentlemen, please put your hands together for Mr. Anubhav Srivastava.
So today we are going to talk about unlocking the power of passives. My brief was like a last-minute one, but I hope I'm able to do some justice to the conversation here tonight. And let's start with a little bit of a story. Many years ago, I had a friend who called me up and said they're a little bit confused as to what to do. So obviously I get about 30 or 40 of these calls every week on what people should do, what should they do with their portfolio, where should they invest, aaj real estate, kal gold mein kharidna hai, parso nifty kharidna hai, and all that stuff goes on, right? Now this guy says, oh, I don't know what to do. I said, fine, let's have a chat. And he gives me this huge bundle of papers. I says, what is this? He says, this is my portfolio. And I kid you not, 197 line items were there in that portfolio, which is a little bit of stocks, mostly mutual funds and so on. So obviously this portfolio has been built up over a period of time. And now I needed to help this guy. Every time we get one of these things, we talk about long-term portfolio, hang on to it, equity will do well and all. And guess what the investor's thinking? It's a long-term portfolio. Basically, it means a failed short-term one, right? Now, we want to get away from all of this. We want to make sure that we neither have failed short-term ones or failed long-term ones. We want everything to do well. And at the end of the day, we're not in the charity business. So we should also be able to derive some reasonable revenue to keep our offices going, to keep our homes going, and so on. So how do passives help us with all of this, right? Our basic objective is to help clients grow their wealth, right? Whichever way possible. And today, obviously, we're going to talk about index funds and ETFs. So, problem. What is the problem right now, right? The first problem is that all of our portfolios are unfortunately skewed towards fixed income and equity. Now, in the last 1.5 years, we'll have seen the whole thing is correlated. Portfolios have tanked, and it just causes a lot of heartburn at the client level, right? Second thing is we are unfortunately also forced to do generic portfolios. These will be small tickets. We don't really know how to do asset allocation out there because things change and so on. The third, which is the most important thing, is we have to constantly search for winners all the time, right? So today somebody is doing X, great CAGR. Tomorrow somebody else is doing CAGR. So we want to switch because the clients are hounding us. So this story just keeps going on and on. Last but not the least, we are not able to provide solutions to clients, right? We are constantly in this product selling mode, right? The problem with product selling, it's a great idea, but the problem with product selling is it's not really sustainable in the long term. You have to keep running after that elusive alpha all the time at every single investment level. So we can't then get around to doing things like target date, retirement portfolios, and so on, right? What is the solution? The solution that we have typically is this whole core satellite approach that was pioneered by actually Vanguard, right? And Vanguard is the biggest fund manager in the world today, I guess, after Blackstone. And these core portfolios, we'll get into in a bit, typically will contain indices, bonds, commodities, real assets, money markets, etc. And obviously today, in India, we can use all of these to develop long-term, sustainable, remunerative portfolios for ourselves. And I do run a bunch of these now for about 8 years at my end, right? So what do these portfolios contain? This is the only technical jargon that I will use. These are risk parity portfolios, right? Because you use passives, the risk at the individual constituent level remains constant. A Nifty ETF will do, a Nifty ETF will do whatever Nifty does, right? It won't really change. There's no cash, there's no nothing, right? NASDAQ will do exactly the same thing. The gold ETF will have gold, and liquid Bs will have liquid Bs. So all of that will basically continue. Now, when you mix all of these together, the technical term that the global industry uses create ETF blends, right? Or index fund and ETF blends. What do they do? right? The first thing is that reduces your reliance on picking winners. Because typically, if you blend it well, depending on your client's objectives, you can actually generate a minor alpha over the headline indices, all right? That's important because basically, if you generate an alpha, that's what you get paid for. Secondly, it provides greater portfolio diversification. If I blend Nifty and mid-cap today, literally, both of them, let's say, come from one of our conference sponsors, you get an exposure to about 250 stocks, right? 200, 250 stocks, 150 stocks, depending on which exact index you use. So suddenly, you have all sector, all cap table kind of exposure. You can use these to provide a better post-tax return, right? You can do things like tax loss harvesting. You can, given the recent changes on fixed income and foreign funds that are out there, you can just use all of those to book a lot of, tax losses during the year and help your client do better post-tax returns. And then, last but not the least, you can reduce overall fund management and transaction costs. Now, this is very important because the first question that you ask yourself is, there is that ETF or an index fund fee, and then we have our money that is coming out somewhere. And then how do you basically make sure that this entire thing becomes a low-cost portfolio? Because every time it's a low-cost portfolio, there's more money on the table to be shared between yourself and your client. Right? So why are ETFs great? And to an extent, this also applies to index funds. First of all, you can do single transactions. You are no longer restricted to the size of the client to do any of these things, right? You can do single transaction. I think everything is hovering around $100, or I think Bank B's is probably one of the largest popular ETFs, which have a value of about 430 odd as of yesterday. There are no loads. Obviously, you can just trade it on the exchange. The interesting thing about this is that people will talk about impact cost and all of that. Typically, if you're smart with your trading, or if you're smart with your, just that exit or entry into that particular ETF or index fund, the impact cost is negligible or zero. You get live prices. If the market is volatile, great. We can take advantage of volatility. I'll come to that in a moment. You have live value. Not only do you know what price it is trading at, you have this animal called INAV, so you know what the value of the underlying is. If it's running at a premium, you can make some money by selling it. If it's running at a discount, you get to enter it at a lower than market rate by buying it at that discount. You have lower risk and expenses. Well, it's just no cash call, right? It's just a pure equity or a debt or a commodity or a real asset investment. And these are pretty simple. I mean, everybody understands what a Nifty is. There's no explanation that is going to the client when it comes to that. So what does this portfolio that you build this way do? Now, this chart is 2020 looking backwards, right? So 1 year holding, 2 year holding, right up to 2010 portfolio type of thing, right? Point to point. And yeah, it might seem a little unbelievable, but I'll just get into it. First thing is that you can tailor these by blending different things. You can tailor it to client risks, and I'll come to that chart next as to how that is done. You get an alpha generation beta. If you notice, the first graph out there is effectively the returns versus the Nifty. Right? In this blended portfolio, which has part 7 odd components, debt, gold, equities, and NASDAQ 100, right? At the same time, that same portfolio has lower vols. Better return, lower vols. This is not rocket science. It's simply you're putting your portfolio on the efficient frontier and generating it through mean variance optimization and all those techniques that I'm sure all of us are familiar with, right? So you have that alpha generation. You have significantly lower volatility. You have better Sharpe. Because when you add the first two, you actually have a more efficient portfolio. For every unit of risk that you take, you get a better return. Last but not the least, the expense pass-through is better. The expense pass-through to you and to your client. So you can actually, in this era of reducing revenue, from all kinds of new regulatory changes that are coming up, you can actually create a stable long-term revenue stream for yourself. So 2020 was a horrible time. Aside of the whole pandemic kicking off, the market tanked big time. So what happens to one of these portfolios when the market tanks? Right? These are 3 portfolios that are, don't hold me to it, but an aggressive, higher equity, a conservative portfolio, and there's a moderate portfolio out here. If you notice, these portfolios, they all have a similar shape because they have the same components. The degrees matter. When the headline indices crashed big time, none of these portfolios fell by as much as the index, right? And this is, again, simple maths. If you have a 20% drop in the market, you will need a 25% return to get your capital back, right? Our job is to make sure that that doesn't happen. The moment you get into a scenario where your portfolio does not fall, your client's portfolio does not fall, you're simply better off, right? And the reason for it, we've just seen. Lower risk, better returns. Right, what else can you do with passives? We have about 4.5 minutes left, so I'm going to do this a little faster. You can do tactical tilts, right? Short-term exposure to sectors, short-term exposure to themes. You can do all of that without really getting into the depth of who that fund manager is, what the record is, etc. Right? You want to take a banking exposure, go for it. If you want to take a pharma exposure, IT exposure, all of these ETFs and index funds are available. This will help you take advantage of short-term opportunities, makes it interesting for your client, and gives the client a little bit of a kicker on their portfolio. Right? Now, what's your traditional view for taking these satellite portfolios, right? So core approach we've spoken about. Now this is the satellite approach. This is the alpha generating part of the portfolio. Now, typically core, you'll have large cap, broad market, fixed income strategies, etc. are typical, balanced advantage fund or fixed income plus debt 60-40 portfolio. Satellite would be mid cap, small cap, foreign equity, etc., etc. But the alternative view that is more prevalent now, at least for the last 5-10 years, is you should have right beta, which is exposure to broad markets. They will beat everything. S&P produces this SPIVA report, which says globally between 80 to 90% of all large cap active funds will underperform the index. Now, what that really means is that your probability of choosing that large cap fund manager successfully is about 10%, now, which are like horrible odds. So it's smarter to go down that way. Satellite, on the other hand, is where you get into focused and disciplined alpha strategies. You could typically look at mid cap in India, and you look at foreign equity. Right? So what should we be careful about? Always develop a disciplined framework. You do not want to be jumping all over the place and end up with that 197 line item portfolio for any client. Most tactical allocations should be about alpha generation and volatility reduction. They should be complementary to your core portfolios. You do not want a negative correlation happening because all you make in your core portfolio will be wiped out by the satellite portfolio and vice versa. Alternative and thematic strategies are designed to give you distinct risk levels. Take short-term calls. They don't need to be in your portfolio forever. And then you have the, you have to evaluate it properly, but all market volatility will work for you as opposed to wiping out value from your client's portfolio. So what are the advantages of this? Is obviously you have better than average performance, which is you do better than the market. Limited volatility and cost with flexible packaging. You can design this portfolio literally at every single client level. I run in my book about 23 portfolios single-handedly right now, following basically this methodology, right? And then you have advisor-driven short-term objectives. You don't really need to follow whatever mutual fund manager is out there, or if you're an advisor, you can just create your own strategies for the client, right? Then we have heard about smart beta. So we have a minute out there. So we'll talk a little bit about smart beta, which is the other thing that you can do. This is the next level. Once you've figured out satellite portfolios, you should get into smart beta. Market cap weight indices do not satisfy. I mean, not every client wants to have XYZ percentage of Reliance or HDFC Bank or any of these headline stocks. So you get into portfolios that can be tailored to your client's specific requirement or your own specific requirement. And concentrating risk at the cap-weighted index, maybe not your thing. And then now there are new methods to capture this risk premium. Market cap weighted indices we've just spoken about. What do smart beta do? They allow investors to select beta which suits them best, which is not necessarily the market beta. And some quick parting thoughts. We have a few seconds to go. Core portfolios and satellite portfolios are best suited, using passives out there. Manager selection should not be the primary purpose on the active side. Manager selection should be the primary purpose on the passive side, which will be great for your client. Investors' ability for stock picking on manager selection should not be the thing driving your portfolios. Portfolio construction should begin using ETFs, and then you can start adding alpha strategies to your client's portfolio. That's all I have for now. I'm going to be around in bits and pieces through the day, so if you have any specific questions as to how these things are run, please do reach out. Thank you so much. Yes. Yes.
So you are essentially an advisor to clients, right?
Yeah.
And you hold a substantial part of your assets in ETFs and index funds, I assume.
All of it, yes.
All of it.
Yeah.
How do you make money out of it?
How do I make money on it?
Yeah, manufacturers don't give you anything.
No, I don't take money.
Not on ETFs.
So I...
you have an RIA license?
No, I don't have an RIA license. I have a PMS license.
Okay.
Right? So we basically charge a fee out there. It would not be very different in an RIA mode. I would simply use the same portfolios. The only difference is this way. In this one, I trade on behalf of the clients. In an advisory form, you send out the instruction to the client trades, through one of these small case wealth desk type outfits.
Got it.